What to do when the market keeps crashing. Map out complex, extended corrections. For double and triple zigzags, master market pullbacks.
Welcome back to day 16 of the Time and Cycle Mastery 60-day series. In today's explainer, we're going to take your technical analysis and, frankly, completely elevate it. We're moving away from the guesswork. We're leaving behind that whole strategy of just crossing your fingers and hoping a trade works out, and we are moving strictly toward absolute precision. If you've been following along with us, you already know that understanding market structures is foundational. But today we're combining that structure with the exact mathematical tools the pros use to pinpoint optimal market entries.
So let's dive right in with a massive concept today, discovering the exact percentage a market will retrace. Seriously, just think about that for a second. We've all been there, right? You're watching a market pullback, you're internally panicking, wondering, okay, is it going to stop here? Should I buy in now? Or is the floor literally about to fall out from under me? Well, instead of letting that anxiety run the show, we can actually use specific data and ratios to find high probability turnaround zones. This isn't magic, guys. It's just the pure mechanics of market psychology playing out right in front of us.
But hey, before we start calculating any mathematical targets, we've got to lay down the ground rules. And the absolute, inviolable first rule of Elliott Wave theory is this. A Wave 2 pullback can never, under any circumstances, exceed the origin of Wave 1. A healthy pullback always stays within the boundary of that first wave. If it breaks that boundary, the trend is completely invalidated.
I literally cannot emphasize this enough. This rule is entirely non-negotiable. If the market breaks below the starting point of your first wave, the structural integrity of that new trend is shattered. Boom, gone. That initial 5-wave sequence you thought you spotted, it's officially invalid. Your wave count has to be completely abandoned, and you've just got to step back, take a breath, and reevaluate the market from scratch. Wave 1 must remain intact for the trended supports to be considered valid.
When a valid sequence plays out, you get that initial upward impulse, that strong, exciting Wave 1. But after that initial move, the market naturally has to take a breath. It enters a corrective state. These corrective waves, the move downward, are exactly where our Fibonacci retracement strategy comes into play. According to Elliott Wave principles, remember, markets move in a basic pattern of 5 waves up and 3 waves down. We are focusing intensely on that very first corrective pullback, trying to find exactly where that sequence will stop and reverse back up.
And this brings us to a really illuminating point from our source material. The ones who add Fibonacci know exactly where to buy. It's kind of a harsh reality in trading that a lot of novice traders will just learn how to count Elliott waves, jump headfirst into the market, and still lose their shirts. Why? Because wave counting alone doesn't give you precise entry triggers. The professionals, the ones who are consistently extracting real wealth from the markets, are the ones applying Fibonacci mechanics directly to those wave counts to pinpoint their exact entry zones.
So, how do we actually execute this mechanically? To measure this corrective Wave 2, you have to be super meticulous. Step 1, you identify the absolute exact low of Wave 1. Step 2, identify the peak high of Wave 1. Finally, you grab your Fibonacci retracement tool and you anchor it directly from that absolute low, dragging it all the way up to the peak high. By doing this, you're essentially asking the tool to measure the total distance of that initial impulse wave.
And by anchoring that tool properly, you instantly unveil the hidden mathematical geometry of the pullback. We are specifically hunting for 2 very precise percentage levels that act as our golden target zone. Obviously, as we covered, if the retracement goes beyond 100% of Wave 1, the probability of a valid setup drops to 0. That's our invalidation rule at work. But our high probability targets for a standard Wave 2 pullback sit beautifully right at the 0.5 and the 0.618 markers.
Let's zoom in on that first major level. The very first highly probable target zone for a Wave 2 bottom is the 0.5 or 50% Fibonacci retracement mark. Basically, this means the market has pulled back exactly half the distance of its initial upward surge. It's a hugely common area where buyers who totally missed out on the initial Wave 1 breakout decide that the asset is now essentially on sale. So they eagerly step in, and that provides massive support to the price.
But wait, it gets even more precise. The second, and honestly, often the most critical golden target, is the 0.618 or 61.8% retracement. In the world of technical analysis, this level is legendary. Our sources indicate that Wave 2 typically retraces 0.5 to 0.618 of Wave 1. This 61.8% level is where price action frequently finds its absolute ultimate support.
It represents a deeper pullback, right? So it shakes out all those weak, panicked hands we talked about earlier, but it perfectly preserves the structural integrity of the macro trend before the market aggressively reverses back to the upside.
Now, here's the absolutely crucial takeaway. You don't just blindly hit buy the millisecond price touches that 61.8% line. To execute a truly high-probability trade within this golden zone, you need confluence factors. First off, price must hold firmly above the 78.6% retracement level to remain a high-probability setup. Second, look at your volume indicators. Trading activity should be visibly declining during this correction, which tells us downward momentum is running out of steam. Third, check your momentum indicators, like MACD or RSI for positive divergence. And lastly, look for actual reversal price action, like a double bottom or a hammer candlestick forming right at those Fibonacci levels. When all of those stars align, your signal is incredibly strong.
Which brings us to a final, pretty provocative thought to wrap up today's explainer. As you prep your charts for the next trading session, ask yourself this. If you can mathematically eliminate the guesswork of a market pullback by mastering these exact Fibonacci levels, what could that precision do for your ability to ride the explosive, wealth-generating Wave 3? Because remember, Wave 3 is often the longest, most powerful wave in the entire cycle. By mastering the Wave 2 pullback today, you are perfectly positioning yourself for the massive opportunities of tomorrow. Thank you so much for joining me for day 16, and I will see you in the next one.